Well, with that, let's dive right into Chapter 26, Holders in Due Course and Defenses Against Holders in Due Course and Holders. And that is the primary distinction between an HDC and a regular holder, is what defenses can be raised against each, the holder or the holder in due course. So let's take a look at that in a little bit more detail. Of course, we already talked about this tonight. Old school check fraud makes a comeback. So we do need to be very careful. Now, we talked about this already in Chapter 26, or rather Chapter 25, just ahead of this, is you have an assignee. The instrument being transferred does not satisfy the elements of being negotiable. The instrument is negotiable, but not properly negotiated. So these are the kinds of things as business people that we need to be alert to. And in a normal holder situation, that third party who's the holder, but then all defenses, real and personal, can be asserted against the holder that could have been asserted against the original obligor on the note. So here's your contrasting slide, and I want to focus on this slide for a full understanding of the concept of holder versus holder in due course. This slide 5 for Chapter 26 is a very important slide. So holder, a third party receiving a negotiable instrument that is properly negotiated. Position is equivalent to that of an assignee. The defenses available to the original parties, all of the defenses, personal and real, may be asserted against a holder. Distinguish that from holder in due course. We also acronym that HDC. And one of the things I want to emphasize is that if you're in the BBA program or the MBA program, you may be required to take the ETS capstone exam, either for BBA or for MBA. And it is quite possible in the legal section that you will encounter at least one question out of the few business law questions that will ask you about holder in due course. That's how important this concept is. So it's important that you spend a few minutes on it. Obviously, it'll help you with the midterm exam in a few weeks and with the final exam in our course, but also will help you in terms of preparing for the standardized test. So holder in due course, a third party possesses a negotiable instrument and takes it for value in good faith and without notice of defenses. These three requirements are the basis for becoming an HDC. Again, for value, in good faith, and without notice of defenses. Status only exists where the defense to the instrument is. This is an incorrect statement, folks. In here, please correct your slide. Whoops. Please correct your slide. Is a real defense, because personal defenses cannot be asserted against a holder in due course. So I think it's just a badly worded statement, not necessarily a wrong statement, but we're going to clarify that in a couple moments here. Now, contract provisions attempt to give a status equivalent to a holder in due course to an assignee of a contract. So this is a situation that we talked about a few minutes ago while we were talking about the previous chapter, where you've got a finance company that has taken something on, and they then transfer it to another finance company that takes HDC and tries to enforce it against the consumer. This is not only illegal in some states. The Federal Trade Commission has gotten involved and basically said you cannot do this. So again, you can have a situation, and you cannot have a situation that sets this up where you've got a bunch of fraudsters that are creating this situation. And there are an awful lot of this going on where people sign up for things and they expect that they've gotten a fair deal, and then when the thing doesn't work or whatever, they go back to the original source and they say, hey, this thing's not working, I want my money back. And they say, tough luck, we've sold your note to a third party. And then the third party says, hey, we're a holder in due course. We don't care whether you got fair consideration or the thing works. So that's why we need a law or a legal standard that says you cannot do that to consumers. Now, again, as I said a few minutes ago, you need to be very careful as business people, because as business people, you do not have that same consumer protection that individuals do. So be careful about that as you operate your businesses. And keep in mind, the defense waived are personal defenses. Real defenses are still valid, and we're going to talk about that in a moment. Now, this is the big slide here. This is slide 8 in chapter 26, the requirements of a holder in due course. For value, in good faith, must take the instrument without notice that it is overdue, has already been dishonored, or that any other person has a claim or defense to it. So you must be in good faith and ignorant of any of these potential defenses down here in the third bullet. So this is a slide, as we've talked about in this course so far, that I would make your super slides, your special set of slides when you're preparing for exams and stuff. This is the slide that I would highly recommend. Now let's take a look at this in a little bit more detail. The concept of value. Now, here's something to think about with regard to the concept of value is it needs to be close. It doesn't have to be 100 cents on the dollar. So if you take a $500 note for $495, nobody's going to be concerned. But if you take that $500 note for $50, a huge reduction from its face value, very likely you will not be considered a holder in due course, because you should have, it won't pass your smell test. You need to understand that something's probably wrong. So watch out for that. Good faith is honesty in fact, and that's consistent with the Uniform Commercial Code. Now, without notice, you cannot have actual knowledge of a problem. You cannot receive notice of it. You cannot have a reason to know that there's a problem. Now, part of this third standard for holder in due course includes before it is overdue. So for instance, if you had a note that is in your hands and it was payable on August 31st, well, today is October 1, you're not going to be able to be a holder in due course because it's a whole month overdue. Why wasn't it cashed in on the day that it was due? Now, that doesn't mean it's bad. It just means you will not be an HDC. And if there are some defenses available, then you're going to be subject to all of the defenses and not just the real defenses. And so this is an important concept because it's so obvious. It's an easy one. Now, you can continue to pass along an HDC. An HDC can pass the note to another HDC who can pass it to another. I'm not seeing a lot of that happening in life today. Again, we're not moving a lot of paper, and when we do move paper, it's considered almost suspect from the beginning. So the more that a piece of paper is moved down the line, the more suspect the paper is, making it less likely that the next person down the line can continue to be an HDC. So let's watch out for that. Now, commercial paper takes it free from personal defenses. Transferees, including holders in due course, are subject to the real defenses. We're going to explain that in a minute. The code generally specifies which defenses are real and which are personal. So let's quickly go to the next slide. Now, as I've pointed out to you since the beginning of the course, when you see a slide like this, these are almost always worthwhile because they contain so much information in a compact format, very useful to be part of your super slides. And these are your personal defenses and real defenses. Now, folks, I know everybody's busy. Everybody's got a lot tied up in the mind here. And I am not suggesting that you memorize this table. But I am recommending that you spend some time with this table so that you have kind of a feeling for what's going to be a personal defense and what's going to be a real defense. So personal defense is slight defense, that you paid the thing. Violation of restrictive endorsement, that it wasn't properly completed, that there was no consideration. Number one is most common personal defense. I didn't get what I paid for. On the other hand, a real defense is it's forged. It's not a legitimate signature. A material alteration, somebody changed 100 to 1,000, material alteration. If the signer was an infant, meaning someone under 18, someone who lacks capacity because of a mental disorder or something, illegality, and so forth. So there are certain situations that are real defenses, bankruptcy rather obviously. So anything that's not a real defense is by definition a personal defense. And again, the personal defenses cannot be asserted against a legitimate HDC. And that, by the way, is slide 16. Now, one of the problems here is when you make a payment in full, you should be able to have documentation that shows that the note has been paid in full. So I think that's very important. And of course, one of the standards for that is to get your note back when you go in to make the final payment. Say you have a note at the bank, make an appointment with the bank and say, I'm bringing you cash or I'm transferring cash from an account I have with your bank. I want to liquidate this note and I want that note back so that it cannot be used by somebody else. So there's a protocol that you can follow that provides you some security here. What are the exceptions? Again, number one is a consumer. Again, that may not apply to businesses unless they're micro businesses. State law, Uniform Consumer Credit Code, maximum protection to the consumer by allowing the consumer to assert all claims and defenses against the assignee. And in addition, something we already talked about in the contracts module is that in an assignment, you want to make sure that the party that's obligated is given notice of the assignment so they know who to keep paying or who to keep servicing. Federal Trade Commission prohibits the use of HDC against consumers in credit transactions. And a notice to consumers, 10-point bold type informing all holders any defense available against the seller of the goods can be asserted against the holder. So this is very substantial protection for consumers and prevents the HDC concept from being used against them. Now, rather obviously, if your sister or your spouse or somebody is aware of the transaction, they cannot take delivery and become an HDC. So you can't bestow an HDC on someone. It's rather awkwardly worded. It's called the close connectedness doctrine, but it's rather obvious, easy concept and all that.